of June 2008, hitting a high of 5,503 points during the session. In fact, the last couple of sessions have been very important technically. Yesterday we saw the 61.8% retracement level being broken, and that's from the 2007 high to the low that we saw in 2009, 5,426 points. And above this mark, which we have held, it is blue sky for those Fibonacci watches. In terms of the market, though, we saw the market up by 0.3%. So that's significantly below what we saw in the US, where we did see the S&P 500 up by 1.1% and the Nasdaq doing even better than that, up by 1.7%. And I guess overnight what we did see is a flow of funds back towards those high growth, high momentum areas and away from emerging markets. So markets around the region really underperforming that US stock market, and also the amount of data that we saw come through today. There were three key pieces of data. First of all, we saw Japan machinery orders, a big miss there, but they were the numbers for February, so the market really ignored those. Secondly, we saw the domestic job numbers. We saw outperformance there. And the Australian market, though, did see a little bit of a drop-off, even though the Aussie dollar absolutely soared on the back of the numbers. And then the big afternoon impact were the China trade numbers, and they were a big miss. They had a huge impact in terms of commodity plays. In fact, just having a look at Fortescue, and if I can just bring up the intraday graph for Fortescue, this is what it looks like. You can see that we started on a high. In fact, the stock opened up by 1.6%. By the end of the session, you can see that we finished near the lows. The stock was actually down 2.4%. We saw copper also being hit. We saw spot prices in copper being hit, and we saw copper prices down back to those pre-FOMC minute levels. So copper players like Panos, Oz Minerals down more than 2%. The iron ore players were lower on the back of those China numbers. Of course, the Aussie market also impacted.
In terms of some of the commodities, some of the miners, overdone off the back of the China data or cause for concern?
I guess if we have a look at those iron ore miners, the China numbers were lower than expected, both on the export and the import side. In fact, the imports down by a massive 11.3% when the market was expecting to see a rise of 3%. However, if you drill down into the numbers, we also saw the March import numbers coming through from China for iron ore as well, and this was by the China Customs Office. And if we have a look at those numbers, they were actually quite good. We saw iron ore volumes actually holding up in the month of March. In fact, just having a look at some of those volumes, and we did see an increase of 14.6% from a year ago, or up 17% month on month. And that's in line with the Port Hedland statistics that we have been seeing, where in the month of March, we actually saw iron ore exports from Port Hedland to China increasing by 27% month on month. I think the iron ore miners hit, though, because while we are seeing the demand side of things holding up, we know that the supply side of things have been increasing, and also prices have been falling. In fact, next week we'll hear from Rio Tinto. It comes out with its production numbers, and it has its AGM on Tuesday. BHP and Fortescue coming out with their quarterly numbers on Wednesday. So we are going to be watching those miners very carefully, but of course we know that during the quarter we've seen iron ore prices down by 15%, while we have seen probably supply increase and demand also increasing during that quarter. So those iron ore miners, a bit of a mixed view in terms of these numbers coming through today. We did see those trade numbers missing, but the iron ore import side does remain quite strong from China, but those iron ore miners hit regardless. It has generally a negative impact, and that's because so many of our companies make revenue offshore, and we did see some of that coming through on the Aussie share market today. We did see a higher Australian dollar during that Asian session, and that's because the domestic factors won out. Today was really a tug of war in terms of the Aussie dollar between the very strong job numbers that we saw here domestically versus the very weak trade numbers that we saw coming through from China. And in the end, the job numbers here domestically did win out. That higher Australian dollar, bad news for stocks like QBE Insurance, which ended the day down by 1%, as well as Brambles, which ended the day down lower as well. In fact, just having a look at the intraday chart of the Aussie dollar, it's really quite interesting because you can see the massive spike that we saw on the back of those job numbers, and then we gave back around about half of those gains when those China trade numbers came out, but you can see that we're still at 94.3 US cents, so much higher than during that US session. So the Aussie dollar, a bit of a tug of war. I think think the main thing driving it at the moment is, number one, the domestic factors, and we have seen stronger numbers here in Australia, and then number two, the China factors. It's a little bit different for the equity markets, I think, because the share market, such a large weighting of our market is in those commodity-based stocks. So I think those China trade numbers have a much bigger impact in terms of the Australian equity market.
Mike, when you